What's up guys, Taiki here, and today I wanted to follow up on my call that I made a few months ago when I declared the end of the DeFi bear market, and a new DeFi bull market is emerging before our very eyes. So when I made this video back in July, right, the end of the DeFi bear market is here, I mentioned that the next resurgence in DeFi is not going to be led by just pure Ponzi-nomic things that we all grew and love and now hate, but it's going to be via tokenized treasuries, right, yield-bearing dollars or real-world assets. And the thesis is pretty simple. The Fed raised rates from 0 to 5%. The risk-free rate is 5%. So why would you risk your capital, right, your stablecoins on chain when you can bridge it to fiat and put it into Fidelity or something to earn like 5.3% in short-term T-bills? And I personally believe that DeFi just can't be this phenomenon that works only in low-rate environments. If DeFi can't function in a high-rate environment, then the system itself is fragile. And for DeFi to become anti-fragile, we need to be hedged, right, in low-rate environments and also high-rate environments. In low-rate environments, yeah, like bull markets can happen, but in high-rate environment, if capital just leaves the system, then we're basically at the mercy of whatever Jerome Powell does. But by tokenizing these treasuries on chain, we can actually create better products than our TradFi counterparts, and actually create sticky liquidity, so capital doesn't actually leave the system. And Maker was one of my calls, right? I think Maker is going to continue doing well, and their TVL for their RWA strategy is up only. Even staked USDT, right? This is on Tron, has $2.3 billion market TVL, and it's also up only. And I know people think Tron is a joke chain, but if you actually look at the price the past year, it's literally up only, right? It's outperformed Ether. So has Maker. And I actually looked into this because I was curious, and we at HFA Research, we published this report. I'll put this in the description if you're interested. It's in our newsletter, but look, I'm not really suggesting people buy TRX. I do not own any TRX. But if you actually look at the fundamentals, right, like over half the Tether supply is on Tron. And whenever people move Tether around on Tron, right, because there's no other use case for Tron other than moving stablecoins around, it actually burns some of the supply. And you can kind of see that, in the past year, TRX has been deflationary, just because people are moving, stablecoins around. So the use case for just being like the stablecoin chain, right, or like the RWA project or RWA chain has a lot of potential, right? The total addressable market is huge because the amount of stablecoins that could potentially be, minted, right, and enter the circulating supply on chain is also huge. And in an era where Ether, recently prices have pumped and we're all euphoric, but I still think that we can't just expect price to pump and then have everything just go up only. We do have to fix the core problems within DeFi if you actually want to see a sustainable DeFi bull market. So I prepared a slide for you, so let's talk into this, or let's look into this. And as always, none of this financial advice. I'm like some dude on the internet, no idea what I'm talking about. So I think the first thing you need to just go back to our roots, right? I'm kind of like a history teacher here, right? Let's understand the history behind DeFi bull markets and DeFi bear markets. I've experienced both. Bull markets are euphoric, and then bear markets get really sad. And I'm sure everyone can empathize with that. And the 2020 DeFi bull market, it was catalyzed essentially, post-COVID, and the Fed set rates to 0. And there's nothing to do. If you want stablecoin yield, you go to Fidelity, it doesn't pay anything. So people just naturally went further and further at the risk curve, and eventually capital found its way on chain. So this is 2020, right? TVL was basically 0, right? You can't even see it here. And then it's went up only into late 2021. And stablecoin liquidity is very, very important for crypto prices, because for every dollar that enters the crypto ecosystem, some percent of it trickles into buying tokens. Yeah, for example, if you the first $10,000 that you deposited into crypto, what did you do with it, right? Maybe you just farmed with $2,000 of the USDC, but with that other 8,000, you just degen your way on chain, right? So in order for crypto to do well again, we have to create stablecoin demand, right? We have to get people to mint stablecoins, right? We have to create demand for those inflows, and then we also have to stop them from flowing out off the chain. And DeFi really hasn't solved the issue in the past, let's say, year and a half, or even the past 2 years. And it's kind of like this multiplier effect that we learn in economics, where when it comes to reflexive systems, whenever money comes into the chain, people buy stuff, price goes up, and then as price goes up, the fundamentals, right, the perception of crypto gets better, right? And then it's price goes up, TVL goes up, then the fundamentals must be good. And then that also creates this reflexive system where as soon as price goes up, it makes people think that things are like amazing, and then people buy because of the fundamentals, and then as price goes up, more people buy, and then price goes. I mean, yeah, it's kind of like this reflex system, and on the way it's amazing, but this also works on the way down, right? Price goes down, things look bad, fundamentals are bad, people sell because perception of DeFi sucks, price goes down. Yeah, it's like the same loop over and over again. So, I think the most important thing that, as a DeFi bull, is to think about, okay, how do we get more stablecoins, right? Like just track stablecoin liquidity, and think about the types of products that DeFi and crypto developers can create to create demand for stablecoin liquidity. Because dollars flow in, price goes up, yields go up, everyone's rich, more speculation. And obviously, right, like we kind of want like sticky liquidity instead of like just like crazy pump and dumps. And of course, the 2020, 2021 bull market was amazing, but in March, the Fed started raising rates, the fastest rate hike cycle in the history of the Fed. And this was March 16th. TVL was like 160, and then ever since then it's been down only. And it has stabilized. I think thanks to real world assets. And in order for crypto to see like a real bull market, this has to get back to all time highs, right? It's like 200 billion. And I mentioned in like the video, the end of the DeFi bear market is here. I'll put this link in the description. That until on-chain yields that are perceived safe, right? Because like risk-free rate's 5%, you can earn 30% on like some random farm, but is that really safe? Does it scale? No. So unless on-chain yields that can scale, that are safe, right? That are perceived safe, can offer higher yields than whatever the risk-free rate is, we can't really have a sustained DeFi bull market. And that's kind of the thesis that I've been laying out. But if that's the core problem, right, we have to think about like what's the problem within DeFi, and then think about the solution. And I think I found the solution, which I've been talking about on my channel for the past couple of months. And like on-chain yield strategies can't compete with the risk-adjusted return of buying short-term treasuries. And that's why DeFi isn't the winner, right? People think that, the Fed's going to cut rates soon, but the market is pricing in that we're going to hold these rates at least until the latter half of next year, and then we're going to go back down to, let's say, 4.5% by the end of 2024. But I also argue that can DeFi even compete if the risk-free rate is 4.5%? I'm not even quite sure, right? Like on-chain crypto projects, like products, just aren't that good, right? If you like just be real with ourselves, and like sure, like if rates go back down to 2%, then like maybe DeFi can compete. But if you can go to Fidelity, clip 4.5%, like are people really gonna like deploy capital into DeFi en masse? Probably not. So I still think that we're going to be in this high for longer, right? This type of macro environment. And I know people disagree, but I'm just saying, hey, this is like what the market is pricing in at. So I think as DeFi bulls, as crypto bulls, we have to be hedged for this type of scenario. So that's the problem. But what's the solution? Let's build tokenized treasuries, right? Let's tokenize these T-bills on chain and create yield-bearing dollars. And this is like a term that I've been trying to percolate within crypto. I think whenever I say real world assets, people get triggered because then they're like, oh, like, are you saying that Bitcoin and Ether is not real, right? Oh, like I'm real, right? People get triggered, right? Because it doesn't really fit, like how their like perception of the world should be, right? When it comes to crypto. But I think that, in order for crypto to get more mainstream adoption, we just have to create these super basic, super simple, products, and then we can create products on top that can actually enhance the risk-free rate, and just general crypto in general. You know what I mean. And like I mentioned, Maker TVO up only, and whenever. So basically like DAI is backed by USDC, right? And it's like some Ether, but like mostly USDC. And if the DAI market cap goes up, that means more USDC backing. And with the backing, Maker, they've been just like redeeming USDC in the fiat and buying treasuries. And whenever these T-bills mature, those flows go back directly on the chain. So if you stake DAI, you earn 5%. And with the excess profits, Maker is buying back its own token, right? So this is like, their yield-bearing dollar strategy. So if you think about it, right, this is creating positive sum games. Because, let's say 6 months ago, like how do you make yield in DeFi, right? You either LP for like a farm, right? And you dump the token. You either LP for like a perpetual DEX, and you make money whenever people lose money. So it's kind of like this closed loop system where, like the only way that I can make money is if someone else gets liquidated, right? That's kind of like what's been happening here. But if the yield, if the source of the yield is coming directly from T-bills, then that creates a positive sum games, right? Like no matter, if like, I don't know, like 1,000 people, right, buy SDAI, right, buy DAI and stake it, then the yield stays flat. The SDAI yield is dynamic, so it could go down to like 4.8%-ish in the future, but just trying to be general here. And I think the main benefit here is the composability, right? We talk about DeFi Lego blocks, DeFi Legos, where if you create like this yield-bearing asset, for example, SDAI, you can create like more products on top of it. For example, you can use SDAI as collateral, right? And then you can borrow ETH and then use that ETH for farming strategy. So you can have like this delta neutral position. You can borrow Bitcoin, sell it, long ETH, so you can do like a long ETH BTC trade. But your collateral is earning yield and you're not being diluted. If you hold USDC, if you hold Tether and you just like let it sit in your wallet, the government is diluting you, right? Because like I personally own some T-bills, right? And if you hold USDC not doing anything, then like my share of the pie is growing and your share of the pie is shrinking. So I mean, I think if you've been in DeFi, that alone is pretty obvious. And there's like actual like value core here because with excess profits, you can buy back, or the protocol is buying back its own token. Because if the protocol is earning 5.3% off chain and they're paying 5% on chain, and there's like some DAI that's idle, not doing anything, then that delta, right? With more TVL, Maker is able to make more money because they're clipping yield, right? They're charging a fee on top of the yield. And Maker is a good business model for that reason. And that's why I've been saying, hey, like Maker, good asset, good token. I own a bunch. And you can look back on the Maker video that I made in July 20th. I'll also put this in the description below. Okay. And like when it comes to, we've been posting a lot of research reports. If you prefer reading things, then, I think this is going to be more in depth. And, Maker revenue, right? This is the annualized revenue for Maker. It's hitting all-time highs. I'm not sure if you can see it, but it's up here, right? It's at 212 million. It's literally up only. And I don't really see this changing anytime soon. And, these business models, I think, is pretty great because it's kind of anti-cyclical, right? Maker is going to be making like more and more money, this like whether crypto is going up or down. And recently crypto prices are going up and we're all feeling euphoric. But what if crypto prices go down in the next 3 months, right? Then like maybe the fundamentals look a little bit less better, right, for other crypto assets. But for Maker, right, I don't have to worry about it because there's like buying T-bills every month. Those mature, those like dollars flow on chain. Anyone that holds DAI makes more money. And if every SDAI holder is earning 5%, then at some point, with like more and more capital, they can buy crypto tokens. And you kind of have like this, like this trickle down economics, I suppose, where anyone that holds tokenized treasuries is like becoming wealthier, right? At least in like fiat terms. And at some point, if they want to buy like crypto coins, then they have more dollars to do so with. So, positive sum games, yield is coming from government interest payments, not from people being liquidated, right? Not from token holders getting dumped on. And I think this is how DeFi can slowly recover. And I think we're seeing it now, right? I mean, like crypto prices are up, and Maker and like other assets I own, like other like RWA tokens have been doing well, like as well. And I think what could be interesting here is basically like Maker and other tokenized treasury projects, they're kind of doing like a slow vampire attack of USDC, right? Because to redeem Tether, I think you have to be whitelisted and you have to be KYC'd. So there's like friction there. But to redeem USDC, all you need is like a Circle account, like a Coinbase account. And there's like no fee. So what we're seeing recently is the USDC market go down only, just because, like people are, like, for example, like Maker is redeeming USDC to buy T-bills. And the USDC market cap, like until they fix something, right? Until they do something, I just like don't see USDC like just like growing up only. And maybe at some point they end up charging a fee, or maybe at some point they allow people to stake USDC on chain to earn some yield. I know you can stake or hold USDC on Coinbase to earn yield, but that goes against like the KYC, like the permissionless nature of blockchains. I mean, I have a Coinbase account and like I have nothing against it, but we're talking about DeFi here, right? Like on chain, composable smart contracts, yield strategies that create wealth. That's more of like what I'm going for. Right? And like Tether, right? They do the same thing. They buy T-bills with the backing. They keep all the profits. If you hold Tether, they don't pay you anything. they make $1.5 billion in profit in Q1, and they make $1 billion every single quarter. It's a cash flow machine. And Maker is the only permissionless way for the public markets to gain exposure to the very profitable stablecoin issuer market. And I mentioned before that I am not a Maker maxi. I just own Maker because it's like the best asset to hold. If you kind of look at like where the market is now, but sometime in the future, right? I mean, we're already seeing this now, right? Like more and more projects are issuing tokenized treasuries, and like the pie should only grow, right? That's the bet I'm making. Is like a great migration of capital from non-yield bearing dollars like USDC and Tether to yield bearing dollars like SDAI, SFRAX, Canto, stablecoins, staked USDT on Tron. You might not be interested in the use cases because you might be an American, but like just because for me, I guess I can only speak for myself. Just because I'm like a privileged American that can deposit a bunch of money into like Fidelity, for example, doesn't mean that people that's not like in the U.S. don't want like dollars, right? Because if you're somewhere like in Asia or some other country with like a weaker currency, then yeah, like there's definitely demand to convert your, let's say, euro into dollars, put it on chain, put it into SDAI, right? I mean, that's a legitimate use case. And I think that, it's important to think about not just like us as an American, because like most of my viewers are American, but think about the rest of the world. And I have also heard arguments that like why would I want 5% yield on stablecoins if crypto is going to go up only? And I mean, yeah, sure. Like from a degen perspective, that might be true. But there's always going to be demand for stablecoin yield, right? Because people want to take profits, and people buy crypto, people sell into, let's say, a stablecoin, the money is left on chain. Are they going to bridge it back to Fidelity to earn like 5.2%? Probably not, right? They want to keep that capital on chain, and like the convenience factor is going to create more demand for things like tokenized treasury. So, I'm kind of think more longer term about, okay, how does DeFi just like slowly recover from here? And I think this is like one of my highest conviction like theses that I have right now is, yeah, like more demand for yield bearing dollars. And yeah, like I mentioned, I talked about this with Canto, right? So it's not just Maker, there's Canto. I also hold some FXS, even though it's been underperforming. I'm sure in the coming months, we'll see like even more projects, like, try to, I guess, like eat into the pie, right? Or like, take some market share. And I'm all for it, right? Competition makes for greater products, and greater products is gonna just create more value for consumers, right? Kind of like capitalism, but it's happening on blockchain rails. So let's talk about how DeFi benefits from yield bearing dollars. And like, yeah, I mean, I already mentioned this, so maybe I'm like repeating things, but the yield is paid out in sweet Joe Biden dollars, and people like Joe Biden dollars, right? People like bear post the dollar, and it's going to zero, and who knows, like maybe in like 10, 20, 30 years that ends up happening. But the world runs on dollars, the crypto economy runs on dollars, and people want yield on dollars, right? Like, would you rather hold a 0% yielding stablecoin or a 5% yielding stablecoin? Definitely 5%, right? Like personally, in my opinion. And what's the source of the yield? Interest payments make sense. And DeFi 1.0, right? This was what kickstarted DeFi Summer in 2020. And I guess like DeFi 2.0 and like, those variants, but fees come from other crypto people, and fees come from inflationary tokens. And yes, if money is flowing in, that works. But if money is flowing out, it doesn't work. And then I tried to coin this term. I don't really think it's getting that much traction, which is like fine. It's more about the idea than like the terminology. But DeFi 3.0, fees come from other crypto people, right? Like people being liquidated, and external yield sources, T-bills, right? Like for example, like people are when you provide liquidity, right? Like you deposit like ETH in USDC, right? And you earn some fees or whatever. But in the future, like why would you just deposit ETH in USDC when you can, let's say, LP for staked ETH and staked DAI, right? So the assets underlying your LP is making money, and then you make swap fees on top, and then you make more money. I think these are, I guess like market inefficiencies. It's going to be fixed over time. And yeah, that's kind of how I'm positioned. And yield bearing dollars slowly turn PVP markets into PVE markets. And this is like the base behind like, the end of the DeFi bear market, the beginning of the DeFi bull market. Hopefully you're starting to see it now. It's not going to be like, overnight people are, prices are pumping. I mean, I guess it's pumping right now, but you kind of get the point, right? This is how a DeFi slowly recovers. And protocols that build on top can clip the yield, which is sweet dollar revenue. So that's also the thing, right? Like imagine more and more devs like build products on top of like stake DAI, for example. Like for the services that they provide, they can charge fees, and like token holders make money. Like in theory, Devs make money, users make money, and yeah, I mean, as long as you're not being rugged, right, or scammed, it should generally be better for the entire crypto economy. And despite prices like, I guess, like pumping, these are my YouTube metrics. It's pretty sad, and these play buttons indicate whenever I upload a video and I lose subscribers. And I mean, I guess compared to earlier this year, you can kind of see that there's like been resistance levels around 0, right? You can kind of see like a bunch of resistance here. And then recently, like we're kind of seeing like, oh, like some days I make like 5 subscribers, right? It's like, oh, okay, like we're doing good here. And like if this is a state of DeFi in like the crypto markets, then we do need to create like better products. And I hope that the next cycle, right, the next bull cycle, isn't going to be led by like this pure Ponzonomic stuff. I mean, it's impossible to avoid that stuff, right, because it's crypto. But maybe the Ponzonomic stuff can do well alongside like actual things, right, that actually create value. And that way we have like a more healthier like crypto economy that's going to be more resistant to external shocks, whether it be the Fed raising rates or like whatever. And my prediction is that yield-bearing dollars, it's going to be an up only in TVL sector in the coming months. We're already seeing this playing out. Maker DAI goes up only, Stake USDT up only, Frax Canto, their TVL is going up. And this is not like a like next week, but it's going to be like a year-long thing, right? Or like a multi-year, multi-decade-long trend that I foresee happening. And I want more competition to happen because it's going to create better products for everyone. And I personally think that the yield-bearing dollar sector. So like for me, I hold Maker, Canto, and FXS in that sizing, right? Like I own a bunch of Maker, I own a big chunk of Canto, and I own some FXS. And that was like a more strategic allocation, I guess, strategy from like my part because like Maker makes like $100 million a year. So it provides a good hedge, right, in your portfolio because it's making money and those dollars are flowing on chain. So if the markets are going sideways to down, then Maker should outperform. The one worry that I have is that if the markets are pumping, right, like it is now, then maybe these like these coins might potentially underperform just because Maker is a really good asset, but it has like a cap in terms of valuation, right? Like it's not going to be like a $100 billion asset anytime soon. So if we're in risk on conditions, then people will rotate away from Maker into like higher beta stuff. And I think Canto is like a good hedge against that just because, Canto is more narrative driven, it's more momentum driven. So if I hold those two, right, as core holdings in a portfolio, then whether the markets are going up or down, I should, relatively outperform either. It's kind of like my mindset. I could be wrong on that. I have to, tweak this thinking every single time whenever the markets move like up or down in like significant manner. But that's kind of the way I've been positioned. So far it's going pretty well. But crypto moves so fast that maybe like next month, right? Like people don't care about yield-bearing dollars. I think that's very unlikely given like the product has like amazing product market fit. But if you think about portfolio construction, if you think about positioning, if you think about like risk-adjusted return, it's really hard to do these calculations in crypto just because everything is so volatile. And I opt more for like sleep-adjusted return than risk-adjusted return because how do you even calculate that, right? I just like want to hold a basket of coins where I go to sleep and I don't really have to like stress about it. But anyways, I'm kind of rambling on here. Like every 2 hours, right? $20,000 of Maker is being brought back. All that money is going into protocol liquidity. So Maker is one of the most liquid coins on chain. And it's still a core holding in my portfolio. But, got to be nimble here. And, if you like this type of content, like last thing, I've talked about Maker ETH parity. It's been going up. But, I personally think it's going to get to 1 and beyond. But, if the Bitcoin ETF gets approved, the ETF gets approved, then maybe those coins can just be off the races. And I could be wrong on this. Yeah, and if you're interested in these types of content, please check out the HFA research premium content. I post 2 weekly premium videos a week, just sharing my thoughts on the markets like I am doing now, daily updates, like what I'm seeing in the markets, weekly live streams where I answer any AMA questions, and we also have the largest premium DeFi community in the world. If you have any questions, anyone's always there to answer your questions. But going back and summarizing, the upcoming bull market, it's kind of funny, right? It's like Celsius and BlockFi blew up just because they were trying to bring on-chain yields off-chain, and then there was like some like durability mismatch, or I don't know, like Celsius people like bought Ohm, right? Like what were they doing, right? But like now we're, given where we are in like the macroeconomic environment, we're trying to bridge off-chain yields on-chain. Time is a flat circle. Hopefully nothing blows up this time. There has to be risk parameters in place. Nothing is without risk. And people often give me flack whenever I say, the risk-free rate on chain, because is anything risk-free in crypto? Probably not. But, it's more like lingo, right? Like terminology. You can kind of argue with me over that. But, it's more the idea that matters over like whatever terminology that I use. And, the next wave of DeFi adoption is probably not going to look like what we saw in 2020 and 2021. I get a lot of questions from people saying, hey, like, do you think we'll ever see, like Goose Finance forks or Dino Swap? I mean, if you don't know what those things are, then don't worry, because it's probably not coming back. But it was like one of those crazy things that happened in 2021 that I made videos on, like in Polygon days. And I mean, it was absolutely like insanity, right? Those things are probably not coming back. And I think the next wave of value accrual, like actual value creation in DeFi, in crypto in general, is going to come from different types of assets that create products that better fit for the world we live in. The world is different. The world is constantly changing. So as an industry, we also have to evolve and adapt as well. And for DeFi to reach trillions of dollars in TVL, I think we need TradFi participation. Right? Like crypto just can't be this thing that retail participates in. And I think RWAs are like yield-bearing dollars are going to be the Trojan horse that brings the great capital migration from TradFi to DeFi, right? Like TradFi, like they think everything is a Ponzi, but we as an industry can be like, hey, let's tokenize treasuries, right? You as a bank can issue these things, you can clip yield, like it's gonna be more liquid, right? These things can trade 24/7, and then slowly but surely, more and more capital is gonna flow from TradFi to DeFi. Even Larry Fink, right, Mr. BlackRock here, just like going on TV talking about how bullish he is BTC. Even he said that tokenization is going to be the next generation for markets. So if you think about like which sector are the institutions going to like buy into next? Of course, there's a Bitcoin ETF, ETH ETF. That's pretty obvious. But like, what's going to be next? I think it's going to be more around real world assets, because that's the market that they know and that they understand. So why fight the trend, right? It's kind of like my thinking. Like I'm just gonna hold assets in the sector that I think is gonna perform really well, and I'll like just hold and let it play out. I could be wrong, and if I'm wrong, I'll make a video and I'll get trolled or whatever. But I'm making these videos. I'm researching in public, researching in real time, sharing my ideas. I get some like one of the reasons I like make these videos is I get like direct feedback. Because if I'm like in group chats or like telling people, hey, like what do you think about this, it's like like they don't really care. But whenever I make like these long ass videos, they're like, yeah, like Taiki, you're dumb, Taiki, you're stupid, and then I get more data points, and then I'm better equipped to like pivot or adjust the thesis. And I guess like the pushback that I've been getting around yield-bearing dollars has been positive for me, just because I think that people are fighting the trend, even though I think it's inevitable, in my personal opinion. Like I said, I could be wrong here. And with the yield-bearing dollars, we no longer have to hope that price pumps and people come back. Because if you go online, I think like most people, right, they're kind of like in this 2020, 2021 mindset of, okay, like for people to care about crypto, price has to pump, right? And then once price pumps, people will come back, right? I mean, that's kind of like the sentiment that I get. But let me offer a different point of view. I think for price to pump, we have to create fundamental value, right? I think value comes first, and like users come first, and then price goes up. And I don't think like price can like just pump out of nowhere and then get people to come back. It's like something has to change, right? In 2020, it was like Fed cutting rates to zero, and then that caused everything to go up. But this time around, I don't really think that we can bet on like a 0% environment. And it's kind of like a hedge, right? Price up is great, but let's try to create actual products. And I think yield-bearing dollars is like one of them. And I also made this video in August, DeFi, this video of like DeFi anti-fragility, and the I say DeFi 3.0, where I think DeFi right now, or in like the past year or so, has been fragile because the Fed rates and like we just like nuke to zero, right? It's like goes down. And crypto as a whole is resilient, right? It survived a bunch of shocks. But for crypto to become anti-fragile, we have to be able to adapt to any type of macroeconomic environment, right? Like if DeFi only works in a low rate environment, then like we failed. But if DeFi can work in a high rate environment, lower rate environment, then we've done its job. And I think it's normal, right, for some sectors to perform well in a high rate environment, and some sectors to perform well in a low rate environment. And identifying these different types of sectors can be pivotal, like when it comes to like managing your crypto portfolio and then navigating like the DeFi markets. Like we kind of have like this wave of like DeFi boom, bull market phenomena, but now we're going back to the roots and we're trying to create better products. We have to just create better products or crypto is cooked. Do people want 5% on dollars? Yes. Will stablecoin issuers that buy T-bills with USD backing be a cash flow machine? Yes. That's my maker and candle thesis. Lots of talk has been, there's been lots of discussion on Twitter around RWAs and tokenized treasuries. I'm like just posting this screenshot just because like a lot of people respect CL, his opinion on the markets, and generally I think like a good mindset to have is to like just this is like my thesis, right, that I've been laying out for the past few months. As long as rates are still higher, I want to be allocated to RWAs, like tokenized treasuries, yield bearing dollars, because I think they're gonna on average outperform other crypto assets. And if something changes in the future where Fed cuts rates to 3%, then I think it's reasonable to shift my stance. So it's kind of, it's like the maker thesis is like pretty similar to like the Bitcoin dominance thesis, right? It's like different ways to, I guess, portray that view. But it's kind of like the same idea where, in certain environments, some assets will outperform. So if we're in that environment, then like, let's hold these assets. And then if the meta changes, then let's rotate. I still foresee RWAs doing well in the past, like next couple of months. Even Evan said, right, like the Fed funds rate should be around 4.25% to 4.5% by end of year 2024. Can DeFi really compete with this, right? If the risk-free rate is like this, right? Maybe by end of year next year, stake DAI will yield 4%, but that's still like a pretty good product, right? So that's kind of like the idea that I'm laying out here. So that's gonna be it for me. I don't know. Okay, this video is 32 minutes. But anyways, hopefully this video is somewhat useful. Obviously crypto prices are going up, and I do see this this shift, right, where I talked about this in my past video, but let's just like talk about this. It's pretty interesting. First of all, right, makers are today, but like look, it's hitting new local highs, right? Like only Bitcoin and Maker are hitting new local highs, if you think about it, from like any asset over like $1 billion market cap. I guess Solana too, but anyways, this is like, you go to the 4 hour, and you kind of outline the BTC price here. Let's do this. You kind of see that, obviously, I guess since September, they performed like at par, right? So that's kind of interesting, but I saw this reaction where like Bitcoin goes sideways, Maker goes up, right? It's kind of like a risk off asset, but when the Bitcoin starts pumping, Maker sometimes sells off, right? Bitcoin's pumping, Maker sometimes sells off, and this might just be noise, right? I'm literally looking at the 4 hour, right? I do not trade a 4 hour. I trade things on like the daily, weekly, monthly timeframes. And if you can, okay, let me just put this off here. Okay, let's put this in the log. I don't know. It still seems like a healthy uptrend. Not going to fight the trend. But yeah, like I mentioned, like Bitcoin, this candle's insane, right? So I definitely feel underexposed to Bitcoin. But hey, you place your bets. It's really impossible to predict the crypto markets. Bitcoin just like moves like in crazy numbers when you least expect it. That's kind of what we're seeing now. But I think the crypto world is healing. Okay. And Bitcoin, as Bitcoin climbs a wall of worry, as Ether climbs a wall of worry, we're starting to see that the end of the DeFi bear market is upon us. It's already happened, right? It already happened a few months ago. But I mean, it's already happening, right? It's already happening. You have to just see it. I see it. It's not gonna be overnight. But the healing process has already begun, and now we, as crypto participants that are still left in these very depressing markets, or formerly depressing markets, now we get to benefit the rewards. So thank you guys for watching. See you guys another time, and have fun farming out there. And let me know what you think about yield-bearing dollars. Bye-bye.